Hello, everyone. Today is the 5th of July, 2026, and this is episode number 84 of JustDario Cigar Time. This past week has been incredibly interesting and I would say hectic in the market. We saw incredible movements in the JPY, culminated with government intervention on Thursday after the Japanese market closed. That slammed the JPY, which was about to hit 163 against the US dollar, all the way down to 160. A big move, but not enough to trigger margin calls and spark a dangerous volatility event in global markets. Afterwards, the currency closed the week at 161.3, all in all confirming the course of action expected by the Japanese government. I mentioned this in my previous video last Thursday. Video that I suggest you to watch if you didn't so yet earlier this week. The second important update today is about META, that this week threw a wrench in the AI narrative. As I described in the article I published on Thursday, and in an addendum that goes deeper into the technicalities and consequences of such a move, which I shared with my previous subscribers on Slice Finance, the impact of that announcements on the share prices of NeoClouds was impossible to ignore. NeoClouds are companies whose sole business is building data centers and selling compute capacity, and all of them closed deeply in red for the week. There was a sharp drop in the aftermath of Meta's announcement, even if Meta shares reacted positively on the same day, mostly because of the always hyper bullish narrative that sell side research tends to throw up on their most profitable clients. It did not take long for many people to start asking a simple yet very important question. If Meta was one of the largest buyers of GPU capacity and they now have overcapacity, hence they are going to set up a cloud business unit to sell that in the market. Does this mean there is no compute constraints in the market anymore? Meaning, will this lead to a reduction in capex expenditures? And as a consequence, reduction to purchase GPUs, memories, and everything needed to expand this infrastructure beyond common sense as it happened till now? The answer to this question is fairly obvious. There is a problem of overcapacity in the market. Is it always the case it was during the dot-com bubble, when companies rushed to build infrastructure? They built way more than real demand could absorb. This is effectively repeating nowadays, as I've warned about over and over again. I hope nobody among you, my dear followers, has been surprised by this course of events. Does this mean it is the moment to start shorting the AI bubble? You need to be very careful about that. Shorting a bubble that is mixed with an incredible degree of circular finance, round-tripping revenues, and a sprinkle of securities fraud is very dangerous. Best way to visualize how difficult this is going to be is to look at the Korean KOSPI index. It opened with a significant gap down after the META news, mostly because of the impact of SK Hynix and Samsung shares. A recovery was staged on the same day until the first support level, which, after being breached, became a technical resistance. From there, the selling resumed, and it closed the day at minus 8%. However, the following day, when US markets were closed, the KOSPI continued to puke at start. But once the second level of support was reached, significant call options purchase activity started to heavy lift the market. This turned the momentum back up and staged an incredible recovery, with the KOSPI ending the week exactly below the now level of resistance. It was purely a technical move, triggered by what is still strong euphoria and a bullish perception in the market, combined with max fear of missing out type of trading. Now that we're done with these important updates, let's dive into the main topic for today. I want to start by showing you a picture I generated. This picture is the best example of what is going on in the oil market. One side, as you can see in the background, you have a big oil tank with a $68 per barrel price tag. However, there is someone on top of that tank looking into it and wondering why it is empty. Then you have a person at the gas station refilling his car, paying $4 a gallon. This person is looking at the price per barrel on the oil tank and wondering why gas is so expensive if the oil is cheap. Now is when it becomes important to understand what the 3-2-1 crack spread is. This crack spread is the crude oil industry standard benchmark used to estimate an oil refinery's gross profit margin. It calculates the difference between the cost of crude oil inputs and the market value of refined products like gasoline and diesel. It can be summarized in a fairly easy formula. You take the price of 2 units of gasoline and you add the price of 1 unit of distillates like diesel or heating oil. Then you subtract the price of 3 units of crude oil and you divide everything by 3. As you can see in the chart in front of you, the current crack spreads are above and beyond any previous all-time high. At $58 for the first time ever, the gross margin of refineries is close to 80%. That is assuming the crude oil price of $68 per barrel in the market is trustworthy. At this point, I bet all of you have a question on your mind. If the crack spread is so high, the value of oil refiners' shares should have, boom, exploded. They should have more than doubled, if not tripled, considering the level of the crack spread. These people are supposed to be printing money as if there is no tomorrow, right? In reality, as you can see in front of you now, shares of oil refineries barely added any gain since the start of the conflict in the Middle East. They are just above 6% in the period of observation. Okay, hold on a second. If refiners aren't making money, who is monetizing the very elevated crack spread? As you can see in the following chart, the market believes nobody is monetizing it. Not energy companies, not oil exploration companies, not refineries whatsoever. Needless to say, this is a complete market dislocation. The reason why the crack spreads are at $58 in the US and are very elevated in Europe is that someone is selling gasoline and diesel, earning those margins. They are selling at an extremely high profitable levels compared to the crude oil price. Furthermore, such an elevated level of crack spread is supposed to be a signal of incoming shortages because demand remains elevated. Further proof of this stress in the crude oil market is in the latest report of the EIA. The most important section has been the confirmation that Cushing is operating at tank bottoms. As I reported in my review I published on Slice Finance and made it public for everyone, so feel free to check it out. I stated that while there has been a draw in every single commercial crude oil inventory region in the US, East Coast, Midwest, Gulf, Rocky Mountain, and West Coast, however, the only subsection of relevance that registered appeal was Cushing, Oklahoma. It fell to 19 million barrels last week, but in the latest report this week, it rose to 19.7 million barrels. Let's not forget, it reports the number as of the 26th of June, so there is a lag. This is a sign that crude oil in the system has been diverted to Cushing to make sure it remains fresh. Cushing is the hub where most of U.S. pipelines for onshore distribution and external export converge. If that inventory falls below the minimum operational level, the system falls into a seizure and breaks. Before we continue with the next section, I have an important announcement. On Sunday, 9 p.m. Eastern Time, I'm hosting my first ever live stream on Slice Finance. Slice Finance is the platform I joined to share my premium content with subscribers who can also directly interact with me in the community chat and in the market live chat I use during trading hours to post real-time updates. If you want to join my live stream and are interested in my premium content, you can find the link to my Slice Finance in the description of this video. Now, let's get on to the second part of today's podcast. I believe there is no doubt among you, after the many updates and data I shared during my previous weeks, that the crude oil price has been heavily manipulated. Now, what has become incredible in the past week is how both price manipulation and the narrative to cover it up reached an extreme. The extreme point is the utterly nonsensical claim that the oil market shifted into a glut. This narrative has been pushed so hard by mainstream media. It has been embraced across the board very quickly and very surprising, but it doesn't make sense with anything happening in reality. This chart shows how the economists, for example, perfectly timed the top of crude oil prices. But then they claim now oil prices were still undervalued at that moment. Now they came out with an article apologizing for being wrong. This article might have been perfectly timed the bottom of the current price cycle. It came out exactly when oil prices closed the price gap from March the 2nd earlier this year. I couldn't think of a better way to conclude this section than showing you a chart made by HFI Research, an incredibly good chart. It shows how the market has never been in this situation before. While the 3-to-1 crack spread remains incredibly elevated, pricing on top of the lowest Brent price ratio in history, this dislocation shows how the math in the market is completely wrong. Either these crack spreads crash or crude oil prices will snap back up to bring the market back into equilibrium, as I discussed in episode number 83 last weekend. Before we continue, if you like my content, don't forget to like, subscribe, and turn on the notifications if you don't want to miss any of my future updates. The last part of today's podcast, I want to focus on the Strait of Hormuz. There is complete confusion about what is really going on in that part of the globe. I want to start by showing a post I shared on X on Friday, on top of a report of how Dubai physical premiums were now trading at a discount. Furthermore, that post highlighted how there is clearly a problem in the Middle East that should be marketing September loading cargoes, not barrels for next week. Here is what I said publicly for the first time after reporting it several times to my subscribers. The problem is that there are virtually no ships willing to sail into the Strait of Hormuz to pick up that oil. I said virtually because some inbound oil tankers still make their way in, mostly Iranians, but some non-Iranian under heavy U.S. military escort using the Omani water lane. As a result, the tanks in the Middle East remain near full, and because of that, production cannot be resumed. Here is the conclusion. Traders are misunderstanding Middle East aggressive discounts. They see them as a supply glut when they are used to lure in buyers. Roughly 24 hours later, this very important headline appeared, and it didn't really make the rounds on social media or mainstream media. It was about the Total CEO who said Middle East producers are desperate to sell their oil stock. Why? Because until they manage to unload their tanks, they cannot resume production. So objectively, nothing is back to normal. The market isn't in a glut whatsoever. That is pure narrative creating an incredible mispricing in the oil paper market. The number of ships transiting the Strait of Hormuz is another proof. Number are still a far cry from the normal transit before the conflict. Furthermore, there is still a very low number of inbound ships willing to enter. This means the market is clearly misunderstanding the whole situation. The deficit between supply and demand of crude oil persists. Oil inventories across the globe continue to decrease beyond warning thresholds. Eventually, at some point, this whole thing will come to a halt. The price will hit a brick wall and be forced to snap back to reality. A reality far above the current suppressed level of $68 a barrel. And here is where I want to conclude for today. If you have any questions or comments, don't hesitate to drop them in the comment section of this video. Thanks a lot for listening to my update today. Thanks for supporting me, X, and for reading my research on JustDario.com. I wish all of you a nice weekend, and for all my American followers, happy 250th birthday to your country. Bye. Bye.